Today on Real Estate Backstage, the Federal Reserve has cut its benchmark rate again in December, although they've signaled that fewer cuts are likely as we move into 2025. Existing home sales are up for the second month in a row. Consumer home buying sentiment hits the highest level in nearly 3 years. The National Association of Realtors issues a cease and desist against the Phoenix REALTORs. And finally, we take a look at what real estate professionals need to know about the new TCPA requirements around the do not call list and one-to-one consent requirements. Now, before we jump in, if you're watching this on YouTube or if you're listening on Apple Podcasts or Spotify, take a moment, subscribe to the show. That way you don't miss any future episodes. And if you want to find the links to any of the articles that we're going to cover today, you can find the show notes at realestatebackstage.com/episode 10. All right, so let's get started with the Federal Reserve. According to Inman, quote, Federal Reserve policymakers approved their third rate cut of the year on Wednesday, but laid out a conservative path for future easing and sent long-term mortgage rates heading up on inflation worries. The vote to cut the short-term federal funds rate by a quarter percentage point was expected, although the Cleveland Fed President Beth Hammack voted against it. More importantly, for bond market investors who fund most mortgages, the latest dot plot indicating where each Fed policymaker expects short-term rates to be in the years ahead showed little enthusiasm for rate cuts in 2025. So I'm going to put this dot plot up on the screen here so you guys can see it. So this is essentially a combination of expectations of all of the Fed officials of where they think rates need to be over the next several years and where their policies should be over the longer term. So you can see over the next several years, 2025, 2026, 2027, and then more longer term policy, where the Fed officials expect their benchmark rate needs to be in order to accomplish their dual mandate of full employment and low inflation. So if you'll remember, in the aftermath of COVID back in early 2020, the Fed was very, very loose in their policy. They cut rates basically to zero in order to stimulate the economy and try to get us out of a recession. And they held that policy there, I think, too long. They were too loose for too long. And then when inflation reared its ugly head, they had to become very aggressive, very restrictive on their policy. And they tightened up, rose rates pretty significantly. And they stayed there for a while. And then in September, they first started to relax policy. And they're trying to find what is that neutral ground? How low should they bring rates in order to get things functioning the way they should be functioning? All right, so the article continues, quote, with today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. Federal Reserve Chair Jerome Powell told reporters after the vote, we can therefore be more cautious as we consider further adjustments to our policy rate. Yields on 10-year Treasury notes, which are a barometer for mortgage rates, climbed 11 points as Powell briefed reporters. An index compiled by Mortgage News Daily showed rates on 30-year fixed-rate mortgages soaring by 21 basis points Wednesday to 7.13%. Most members of the Federal Open Market Committee expect that by the end of next year, the target for the federal funds rate will be between 3.75% and 4%, just half a percentage point lower than the current level. The slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation inflation will be higher, Powell said, unquote. So this is pretty significant. We got the third cut that we were expecting for December. We talked about this last week. I thought there was a very, very high likelihood that we would see that third cut, although apparently there was a bit of a debate about it within the committee. However, they had previously forecast 4 cuts next year, 25 basis points each, for a total of 1 percentage point in reduction next year to the federal funds rate. Now they're saying half a point is more likely. So we're going to get half the cuts next year that we were previously expecting. Based on that news, markets reacted negatively. The stock market went down. Yields on Treasury notes and mortgage-backed securities went up. Mortgage rates are up over 7%. So we've been talking about this on the show, I don't know, the last several weeks where, we've been seeing inflation readings that are higher than expected. The last 2 months in a row, we've seen an uptick in the inflation rate based on the CPI. And here in Jerome Powell's comments, he said it's not just that we've been seeing high inflation rates, it's that we expect inflation to be higher, maybe moving into next year as well. If that's the case, if the Fed really expects the inflation rate is now kind of drifting back upwards, I'm not sure why they did the December cut, but they're certainly not in any hurry to continue cutting rates into next year. They have not solved the inflation problem. Remember, the mandate for the Fed, the target is a 2% inflation rate. And I think the last month's reading was 2.7%, up from 2.6% the month before, if I remember correctly. So inflation seems to be moving back up in the wrong direction. They have not yet solved the inflation problem. And the labor market, although it has been weakening, it hasn't really broken yet. So we talked about this earlier in the week at our all hands meeting here at our brokerage. The period of time between when the unemployment rate bottoms out and starts to go back up, and then we enter into a recession, we are in a weird season where we've bottomed out and we've been slowly ticking back up for a longer period of time than what we normally see. Normally, when we see the unemployment rate bottom out and start to tick back up, it's not that long before we enter into a recession. So something could happen. The economy seems to be a little fragile. A lot of the numbers are good, but we're just in this weird precarious situation where the labor market has been softening continuously. The number of new jobs being added has slowing down. But the figure that we really want to keep an eye on is the initial jobless claims. That has been rising, but it's been rising very slowly. We haven't really seen much meaningful change yet in that metric. All right, so shifting gears real quick, let's talk about existing home sales. So in October, we saw existing home sales rise for the first time in over 3 years. In November now, we're seeing that trend continue. So that's 2 months in a row now where we've seen an uptick in existing home sales. So according to Inman, quote, existing home sales rose 6.1% in November, the largest year-over-year gain since June of 2021, and increased 4.8% from October for a seasonally adjusted annual rate of 4.15 million. According to data released Thursday by the National Association of Realtors, NAR chief economist Lawrence Yun said more buyers are entering the market as they learn to adapt to higher mortgage rates. Home sales momentum is building, Yun said. More buyers have entered the market as the economy continues to add jobs, housing inventory grows compared to a year ago, and consumers get used to a new normal of mortgage rates between 6% and 7%, unquote. Now, existing home sales have been moving in a positive direction over the last couple months, but the new construction sector does appear to be slipping. So according to Housing Wire, quote, housing starts are back at the level seen during the COVID-19 recession in 2020. Interestingly, employment for residential construction workers, typically one of the first areas to experience declines before a recession, has not yet seen its usual downturn. Several factors have been keeping labor steady, such as working through a backlog of orders and long turnaround times to complete projects. Perhaps most importantly, some home builders have been subsidizing mortgage rates to help maintain employment and finish ongoing projects. The key points of this report indicate that the Federal Reserve has overlooked the housing market for years. The new home sales and housing starts sector does affect future housing production, which is crucial for addressing rent and home price inflation. This sector is closely tied to the overall economic cycle and tends to show patterns before every recession observed in recent modern history. With the labor market cooling down, particularly in the private non-farm payroll data, can this sector be completely ignored in 2025? Unquote. That was an article by Logan Motoshami at Housing Wire. So if the new construction market continues to lose steam, we are likely going to start seeing some layoffs of residential construction workers, which tends to be a leading indicator that we might be moving into a recession. All right, shifting gears, home buying optimism is actually up. So this is according to Real Estate News. The Fannie Mae Home Purchase Sentiment Index moved up by 0.4 points in November to 75, marking the fourth consecutive month of upward momentum. The index has jumped 10.7 points in the past year. While consumers are decidedly more optimistic, the index is at its highest level since February of 2022. They are still showing some reluctance to close on the deal, with only 23% of the 1,000 individuals polled saying that it's a good time to buy a home. Despite the relatively small share, the percentage is up significantly from a year ago when it fell to a survey low of 14%. Overall, the findings point to more optimism in the coming year. The survey found that 45% of consumers expect mortgage rates to drop in the next 12 months, which is a new high. Economists have mixed views on where rates will land in 2025, with some expecting them to fall to the low 6% range, but others predicting they'll stick closer to 7%. Consumers are feeling reasonably upbeat about their employment and financial situations as well. 78% are not concerned about losing their job in the coming year, and 16% said their household income has risen significantly in the past year, while just 12% said it had declined. The rising overall sentiment is also likely due to consumers' slow but steady acclimation to current market conditions, said Mark Palem, Fannie Mae's chief economist. Of course, high home prices and high mortgage rates remain the primary reasons why the vast majority of consumers think it's a bad time to buy. Trends that we expect to continue into the new year, Palem said, unquote. The optimism is pretty strong. People are expecting the rate of price growth to slow down. People are expecting mortgage rates to fall. People are feeling overall pretty good about their financial situation, about their employment. So the consumers are starting to feel more optimistic, which is good. That should lead to more sales. All right, so several weeks ago on episode 6 of the show, we talked about the Phoenix Realtors out in Arizona offering something called MLS Choice, which was a membership option available to local real estate agents in their market who chose not to be affiliated with the Arizona Association of Realtors, or NAR. Now, according to Real Estate News, the National Association of Realtors has sent a cease-and-desist letter to Phoenix Realtors saying that the association's new MLS Choice option purports to allow real estate licensees to become members of PAR without becoming a member of the Arizona Association of Realtors, or NAR. In an email sent December 18th by NAR to its board of directors, association leaders, and others, NAR General Counsel Leslie Muchow said it was taking necessary action to defend its three-way agreement, which requires realtors to join local, state, and national associations and to enforce the NAR Constitution and bylaws, unquote. So I'm a little surprised by this, I guess. I was kind of expecting NAR to kind of cave on this, or at least not really push the issue right now with everything else that NAR is dealing with. We've seen a handful of these lawsuits recently spring up from real estate agents and from brokerages suing NAR over this three-way agreement, stating that it's collusive and anti-competitive to force people to join the state, local, and national association levels. We've seen a handful of these lawsuits pop up. And NAR has been relatively quiet about it. We also saw the Park City Board of Realtors out in Utah say that they were going to stop enforcing the clear cooperation policy. So we've started to see this trend of local associations really pushing back against a lot of these NAR rules. So I'm a little surprised that NAR really came out as strong as they did against this move by Phoenix Realtors. So maybe NAR is starting to get a little bit more confident and really wanting to push back and hold some of these things in place. All right, so I want to talk about the upcoming changes to the TCPA under the FCC and how this affects real estate professionals. You may have heard about this, maybe not, and maybe you're already tuning out thinking, well, I don't cold call for sale by owners, so I don't need to pay attention to this. I don't need to worry about the do not call registry or getting one-to-one consent because I don't go after those types of leads. Well, as we're going to get into, this is going to apply to you even when you're doing lead follow-up from people that are referred to you or people that you meet at an open house. You need to be aware of these rules and how they impact your business. So this is according to the National Law Review. Quote, on January 27th of 2025, the Federal Communications Commission's new consent rules for robocalls and robotext will take effect. The FCC aims to close the lead generator loophole by requiring marketers to obtain one-to-one consumer consent to receive telemarketing texts and auto-dialed calls. While the rule primarily targets lead generators, it could affect any business that relies on consumer consent for such communications or purchases leads from third parties. Under the rule, businesses must clearly and conspicuously request and obtain written consumer consent for robocalls and robotext from each individual company. Companies can no longer rely on a single instance of consumer consent that links to a list of multiple sellers and partners. Instead, individual written consent will be required for each marketer. Additionally, any resulting communication must be logically and topically related to the website where the consent was obtained. To meet this requirement, businesses may allow consumers to affirmatively select which sellers they consent to hear from or provide links to separate consent forms for each business requesting permission to contact them. So the big problem that they're trying to solve here is what they call the lead generator loophole. That's where a consumer goes online, they're on a website, and there's a form that they fill out, and there's consent language that says, I agree to be contacted by such and such company, along with their affiliates and partners and blah, 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 right? And they click the button, and maybe the expectation is they're only going to hear from one salesperson or maybe two salespeople, but that lead can get sold to 10, 20, 100 different service providers, and technically they've opted in to be contacted by that many people. Sometimes there will be a link with a list of all the people that they agreed to be contacted by. Now, what they want to do is have what's called one-to-one consent. So if Realtor.com, for example, is a company that does this, they typically sell the leads to two real estate agents, but they will also sell that lead to mortgage lenders and maybe some other service providers as well. home warranty companies, etc. So when a consumer is on Realtor.com and they see a property they're interested in, and they click the button that says contact agent, 99% of the time, these people are expecting to only be contacted by one real estate agent. But Realtor.com, by default, tends to sell that lead to two real estate agents. And sometimes the one of those two people might be a reseller as well. I think that's how OpCity got started, which is now owned by Realtor.com. But what OpCity originally did is they would purchase these Realtor.com leads, and then they would sell them as additional leads to other people. They had a call center. They would call them, get them on the phone, and then resell those leads to agents as well. So, sometimes if Realtor.com is selling the lead to two parties, those parties could be reselling the leads. Or maybe one of the buyers of that lead is a team or a brokerage that disseminates that lead to multiple agents within the company. So Realtor.com then is also selling that lead maybe to mortgage lenders, home warranty companies, home insurance companies. So that one form that a consumer fills out and clicks the button could result in them getting a dozen, 24 phone calls from all these different service providers. So that is the problem that they're trying to solve here. Now, this one-to-one consent rule only impacts you if you're using what's called a regulated technology. So if you're using an auto dialer, if you're doing robocalls, if you're doing robotext, and we'll get into the details of exactly what those terms mean. According to the statute, so this is actually from the TCPA, the Telephone Consumer Protection Act. According to the statute, quote, the terms automatic telephone dialing system and auto dialer mean equipment which has the capacity to store or produce telephone numbers to be called using a random or sequential number generator and to dial such numbers, unquote. A lot of people think that in order to avoid using a quote-unquote auto dialer, you have to manually punch in the phone number. That is not true. I've had some people recently say, well, this TCPA change is going to impact me because I typically make my phone calls through my CRM. So, for example, here at Bluefield, we use Follow Up Boss as our CRM. They have a built-in dialer. If you're looking at a lead's contact page, all you have to do is click on their phone number, and it will instantly call them for you right there through your computer. That is, we use the phrase auto dialer or dialer, but legally that's not what it means. Legally, an auto dialer is a system that has the ability to randomly generate phone numbers to dial. It's not just you push a button and it calls the phone number. So in 2021, for example, there was a Supreme Court case, a Supreme Court ruling in a case against Facebook that narrowed this interpretation of what an auto dialer is. So according to Crowell and Mooring, quote, in Facebook Inc. versus DeGuid, the Supreme Court held that to be considered an automatic telephone dialing system, or an auto dialer, for purposes of the TCPA, a device must have the capacity to either store a phone number using a random or sequential number generator, or produce a phone number using a random or sequential number generator. In so ruling, the Supreme Court overturned the Ninth Circuit's holding that an auto dialer needed only have the capacity to store numbers to be called and then to dial such numbers automatically, resolving a contentious circuit split on the scope of the term auto dialer. Congress passed the TCPA in 1991 in an effort to combat the proliferation of intrusive nuisance calls from telemarketers to businesses and consumers. With certain exceptions, the TCPA generally prohibits using an auto dialer to make calls or send text messages without the called party's prior express consent. So this case was kind of interesting. There was a gentleman who received a automated text message from Facebook claiming that they needed to verify his account or that someone was trying to log into his account or something like that. And he tried to unsubscribe because he didn't want to get these texts from Facebook. Apparently, he didn't even have a Facebook account, so not sure how they got his number. But he ended up suing Facebook because he was unable to get them to stop texting him with these security alerts saying, hey, we need to secure your account. You need to change your password. Someone's trying to log in. He sued Facebook over that and it went all the way up to the Supreme Court. But the Supreme Court held that Facebook did not violate the TCPA because the system they were using to text him was not considered an auto dialer. According to the court, an expansive interpretation of auto dialer, such as DeGuid's, would capture virtually all modern cell phones and, quote, take a chainsaw to these nuanced problems when Congress meant to use a scalpel, unquote. So since that Supreme Court decision in 2021, there's actually been a whole lot of cases. So we have an exhaustive list of case law here to support this. If you're interested, I'll put a list to all those recent cases in the show notes, and that's courtesy of the folks over at tcpaworld.com. All right, so if you are using a pre-recorded or an AI-generated message that would be considered a robocall. So if you're using one of these companies like Sly Broadcast to do the voicemail drops, ringless voicemail, where you pre-record a message and then it automatically drops it into people's voicemails, or if you have a pre-recorded message and then your system dials people and as soon as they answer, it just plays the message that you've pre-recorded, either you personally or some type of AI-generated voice, that is considered a robocall. Now, a robo-text would be any type of pre-written text message sent out by automation through an autodialer, so through a software that has the capability of generating numbers randomly and then sending out phone numbers or text messages to them. So under the new rules, sending a text message to someone on the do not call list is going to be treated equivalent to a phone call. So no longer will you be able to say, well, I wasn't calling the person on the do not call list, I was only texting them. Moving forward under the new rules, that will not be allowed. So according to the Federal Register, quote, the commission adopts the proposal to codify the National D&C Registry's existing protections to text messages. Texters must have the consumer's prior express invitation or permission before sending a marketing text to a wireless number in the D&C registry. The commission previously concluded that the national database should allow for the registration of wireless telephone numbers and that such action will further the objectives of the TCPA and the Do Not Call Act. The Commission's actions is consistent with federal court opinions and will both deter illegal texts and make D&C enforcement easier, unquote. All right, so let's talk about consent for a moment. So when you're using one of these regulated technologies, you don't just need implied consent. You need express written consent. So for example, if you meet someone at an open house, if you get a referral from a past client, if somebody calls you based on the number on your sign and then you enter them into your database, into your CRM, you do not have express written consent from them to communicate with them via any of these regulated technologies. So unless you have a sign-in sheet at your open house where it specifically says by signing into this open house, you consent to receive marketing via auto dialer, robocall, robotext. Unless they're giving you their express written consent at that moment, you are not able to communicate to them with any of these regulated technologies. Now, you can still call them, you can still text them, you can email them, but you cannot use an auto dialer as defined by the statute, and you cannot send them any robocalls like pre-recorded messages, AI messages. You can't do the ringless voicemail drops. That is illegal whether they are on the do not call list or not. So even if a consumer is not on the do not call list, you meet them at an open house, you send them a robocall like a ringless voicemail, that is illegal. That is a violation. So in order to use any of these regulated technologies, whether someone is on the D&C list or not, you need to have express written consent. Now, it can be digital. You can have them e-sign it. It can be based on disclosure and clicking a button on a website form. That's fine. But you can't just have implied consent. Now, that's specifically when we talk about these regulated technologies. You need express written consent, whether they are on the D&C list or not. Now, for other traditional forms of communication, like a regular call or a text, you don't need express written consent if the individual is not on the do not call list. So let's say you have someone who walks into one of your open houses, or they call your yard sign, or they get referred to you by one of your other clients. You at that point, even if they haven't put anything in writing, you have their implied consent to contact them for up to 90 days, even if they're on the do not call list. However, once the 90 days is over, if that person is on the do not call list, you cannot continue to solicit their business. This is really important. A lot of real estate agents do not realize this. If someone calls you based on the yard sign that you have, and they're asking about a house, you answer their questions, even if you go meet them and you show them a house, you have this quote-unquote existing business relationship with them now. You enter them into your CRM. You can continue to solicit their business for up to 90 days, whether they're on the D&C list or not. At the end of that 90-day period, you can only continue to solicit their business if they are not on the do not call list. Once the 90 days is up from that original inquiry, the time that they gave you their implied consent to communicate with them, to solicit their business, you need to be checking the do not call list. So if you are calling or texting people that have been in your database for years, if you never obtained express written consent to contact them by call or text, even if you're not using a regulated technology, if you want to continue soliciting these people, you need express written consent. Not necessarily for robocalls or robotext, but for regular calls and regular texts. If you want to continue to solicit business for people who are on the do not call list beyond that 90-day period from the original inquiry, you do need their express written consent. All right, y'all, that's a wrap for today. This is the last show before Christmas, so I hope you all have a Merry Christmas. Just a reminder, you can find the show notes with links to all of the articles and resources that we went over today at realestatebackstage.com/episode 10. And I'll see you guys here next week for another behind-the-scenes look at the real estate industry here on Real Estate Backstage.